What is going on, guys, and welcome back to the Young and Intelligent Money Investing channel. And today, officially on December 31st, one of the longest running bets in the stock market is over. So this bet is what I'm going to teach you guys about today. But before we get into that, I just want to thank you guys and ask you guys, if you haven't already, drop a like on this video and drop a comment telling me what you think will happen in the next 10 years with the S&P 500 versus mutual funds. Okay, let's get into this. So essentially, who made this bet? This is Warren Buffett versus Ted Sides. What the bet was is that Warren Buffett bet that the S&P 500 would outperform mutual funds after fees over a 10-year period. So the 10-year period was the start of December 2008, and it ended on December 31st. And this has kind of been really up and down over time. And as you guys can see, S&P 500 has been absolutely crushing it right now. But early on, what we can't see on this chart on the left here is that, like, during the recession, the mutual funds were actually did a lot better job of protecting money than index funds did. That's why you'll see here on the right on this bottom chart, when we go into that the return's only 85%, even though you guys, if you've been on the stock market in the last few years, you'll be like, I've probably got 85% in the last 4 or 5 years. So, and that's where a lot of the returns have come from. So, essentially, what Warren Buffett was kind of fed up about with mutual funds is their high fees and their actively managed nature. So Buffett's always been a big proponent of passively managed index funds, and he thinks the more you trade, the less money you're actually going to make. So he made this bet, and it actually turned out very well for him. So let's look at the chart. So when Ted Sides was able to pick 5 different funds, which he would average out, and that average return would be compared against an index fund of the S&P 500. So this is a year 9 chart. Year 10 technically isn't over when I was recording this video, so I don't have an updated chart yet. So obviously the S&P 500 is going to be up another like 20% or so, as it was, because as the market's been up a lot this year, but hedge funds have not caught up. Like, if they had a 80% return in one year, they would absolutely deserve to win, but that just has not happened, and that just isn't realistic for a hedge fund after fees. So Fund A, as we can see here, only returned 8.7% in 10 years, or actually in 9 years, which just absolutely sucks. You could get, I've gotten more than that in the last 8 months investing in the S&P 500. Fund B, 28.3%, respectable. Not very good though. Fund C is the best of them, 62.8%. Still not great over 10-year span, if that's what we're talking about. Fund D, 2.9%. That is hardly breaking even. You're not even beating inflation there. And then Fund E, 7.5%. Honestly, most of these are pretty embarrassing returns, considering that the S&P 500 has returned 85.4% over that same period and has been absolutely crushing it ever since the recession. So the hedge fund average comes out to be 22.0% after 9 years versus 85.4% of the index fund. So obviously Buffett had this bet in the bag a couple years ago, and I think that same trend is going to reign true going forward as more and more people go and invest in index funds, and that's just going to make the broader markets rise, while the people who are trading every day are just going to see their industry keep dying. And I truly believe that trading will not be a big part of the stock market in decades down the line, just because I really don't think it's that viable of an actual thing. I think I'm much more of an investor than an actual trader. A lot of people are probably going to get on me for that, and they probably have points as of now, but down the line, it may or may not be a big factor. I don't think it'll be as big of a factor as it is today. So I hope what you guys take away from this video is that indexing and doing ETFs is a great way to get solid returns on the market. If you're being pressured into maybe just dumping your money into a mutual fund, maybe you're being told you don't know enough about finance to invest your own money, the person who's telling you that is absolutely dead wrong. It's really not that hard to put your money into an index fund, and I really promote a lot of good ones on this channel. So I really hope you guys have positive takeaways from this video. Please drop a like down below if you enjoyed. Subscribe if you haven't already. About 80% of the viewers on this channel watch and then have not subscribed yet, so please do if you haven't already. Drop me a comment letting me know if you've heard of this before and what you think this outlook will be going forward, because in the years previous to this bet actually being made, mutual funds did slightly outperform the S&P 500. They had a really good string of years while the S&P had a decent string of years, so it's really up in the air as to who may win this bet in the future. I am pretty strongly believe it's index funds, and when you're invested in an index fund, you're not paying for these super rich finance guys to fuel up their boat or their jet or anything like that, which I always think is a plus. All right, I'll see you guys in the next video.